$17.40 an hour. That is what the bank pays you to stand between its money and its customers. You are 22 years old. The branch opens at 9. You are there at 8:30 because the drawer has to be counted before the first customer arrives, and the count has to be exact, because if it is not exact, the discrepancy comes out of your drawer, and the drawer is your responsibility, even if the error was not yours. Today, you will process $340,000 in transactions: deposits, withdrawals, wire transfers, cashier's checks. $340,000 will pass through your hands between 9 and 5. Your take-home pay for the full day is $110.72. You are not thinking about the gap yet. You will. The branch is designed to feel stable. The marble floors are not marble. They are a material that looks like marble and is easier to maintain. The lighting is calibrated to a specific warmth because the bank's design consultants determined that warm lighting increases the time customers spend in the branch, and time in the branch correlates with product uptake. The pens are on chains not because customers steal pens, but because a pen on a chain signals permanence. The bank has been here a long time. The bank will be here after you are gone. The pen on the chain says this without saying it. Your job at this level has one actual function. You are the part of the bank that customers see, so they believe the rest of it is trustworthy. The vault they cannot enter, the floors they cannot access. The decisions being made about their money in rooms they do not know exist. You are the face of $1.4 trillion in assets. The face costs $17.40 an hour. The assets cost considerably more to produce. 3 things happen at the teller window that you will only understand later. First, every transaction you process generates data. The data is not yours. It belongs to the bank. The pattern of your deposits, your withdrawal timing, the frequency of your transfers, all of it flows upward into systems you cannot see and informs decisions you will not be consulted on. You are creating the raw material of the bank's actual product, and you are not aware that you are doing it. Second, the products you are trained to mention at the end of each transaction, the savings account upgrade, the credit card, the personal loan, are not suggestions. They are a quota. Your manager tracks your referral rate. Your referral rate appears in your quarterly review. A teller with a low referral rate is a teller who is not doing their full job, which is not processing transactions. The full job is converting customers into additional revenue streams while processing transactions. Third, the bank earns interest on the money sitting in your customers' checking accounts overnight. The average checking account balance in this branch is $4,300. The branch has 2,800 active checking accounts. That is $12,040,000 sitting in accounts that pay the customer 0.01% interest. The bank deploys that capital at rates between 4 and 9%. The spread on $12 million overnight across 365 days is not a rounding error. You count your drawer at closing. It balances to the cent. You initial the sheet. You clock out at 5:17 because the cash reconciliation ran long. You are not paid for the extra 17 minutes because you are an hourly employee, and the overtime threshold requires manager approval, and the manager did not approve it because the overtime budget is already at 93% for the quarter. You drive home. You think about the $340,000. You think about the $110.72. You think about the distance between those two numbers and what lives in that distance. You decide to find out. The bank makes money while you are making change. Understanding the gap between those two sentences is the beginning of understanding finance. 3 years later, your title is branch manager. Your salary is $62,000 a year. You have 11 direct reports. You are responsible for the branch's performance against 4 metrics: deposit growth, loan referrals, product cross-sell rate, and customer satisfaction score. The first 3 are tracked weekly. The fourth is tracked quarterly and weighted at 12% of your bonus. The first 3 are weighted at 88%. The mathematics of your job are not subtle. You begin each Monday with a report. The report shows you where the branch finished the previous week against its targets. If deposit growth is below the regional average, you receive a call from your area director on Tuesday. The call is not hostile. It is structured. Your area director asks what your plan is to close the gap. You tell him. He documents the conversation. The conversation appears in your performance file. You have learned to have a plan before the call. The cross-sell rate is the metric that required the most adjustment when you first took the role. As a teller, you thought of cross-selling as something you did in addition to your job. As a branch manager, you understand that cross-selling is the job. The transactions are a delivery mechanism. Customers come in to deposit a check. They leave with a savings account they did not arrive intending to open. This is not a failure of the customer's decision-making. It is the successful execution of a system that was designed around the gap between what a customer needs and what a customer can be persuaded to want. You have a high performer on your team. Her name is Adais. She processes more transactions than anyone in the branch, and her cross-sell rate is 4.3% above target. She is 24 years old and has been with the bank for 14 months. You know, from your own trajectory, that the bank will not pay her what she is worth for at least another 2 years. You know this because you were Adais, and you know how long the bank waited before it made you branch manager. You do not tell her this. You tell her she is doing excellent work. Both things are true. The product you are required to push hardest this quarter is a personal line of credit at 19.9% APR. The bank's cost of funds, the rate it pays to borrow the money it lends, is approximately 4.1%. The spread is 15.8%. On a $10,000 line of credit carried for 12 months, the bank earns $1,580 in net interest. Your branch has been assigned a target of 47 new personal lines of credit this quarter. You receive a $400 bonus for every 10 units above target. You hit the target. You receive $800 in bonus. You do not spend significant time thinking about the 47 customers who now carry a line of credit at 19.9%. You think about it briefly. You file it in a category of things that are true and not useful to examine closely if you intend to stay in this building. Every institution has a version of this, a system that extracts more than it returns, sustained by people who understand it clearly enough to operate it and not clearly enough to leave. 4 years after the branch. Your title is Commercial Loan Officer. Your base salary is $94,000 a year. Your variable compensation bonuses tied to loan origination volume brought your total earnings last year to $127,000. You work in a different building now. There is no teller window. There is no marble that is not marble. That one. There is a conference room with a glass wall and a whiteboard and a credit analysis system that you have spent 2 years learning to read the way a pilot reads instruments. The credit system is not complicated. It is deliberate. A business owner walks in. She wants $480,000 to expand her manufacturing operation. She has been in business for 7 years. Her revenue last year was $2,300,000. Her debt service coverage ratio is 1.47, which means for every dollar of debt she services, she generates $1.47 in operating income. By the bank's internal guidelines, a ratio above 1.25 is approvable. Her ratio clears the threshold by a comfortable margin. You approve the loan at 6.8% over 7 years. The bank's cost of funds for a 7-year commercial loan is approximately 3.9%. The spread is 2.9% on $480,000 over 7 years. The bank will earn approximately $97,000 in net interest on this transaction. The origination fee is 1% of the loan amount, $4,800, collected at closing. The loan costs the business owner nothing visible at the point of approval. It costs her $4,800 before she spends a cent of the principal and $97,000 over the life of the loan before she considers the compounding effect of money she did not have to borrow. You also decline 3 loans that week. The first is a restaurant owner, 8 years in business, consistent revenue, but a personal credit score of 611 from a medical debt dispute in 2019 that was resolved but not expunged from his file on schedule. His debt service coverage ratio is 1.31. It clears the threshold. His credit score does not clear the secondary screening criteria. You decline. You write the declination letter using the standard template. The letter does not explain which specific criterion he failed because the bank's legal team determined that specific explanations increase dispute rates, and dispute rates consume compliance resources. The second is a woman who wants to open a childcare center. Her business plan is detailed. Her market analysis is accurate. She has no collateral. The bank does not lend against future revenue projections without collateral for loans above $150,000. She needs $230,000. You decline. You do not know what happens to her after the meeting. You do not have a mechanism for knowing. The third is a man who wants to consolidate business debt at a lower rate. His current debt is at 11.4% from a different lender. You could offer him 7.2%. The issue is that his primary banking relationship is with a competitor, and moving the debt to your institution would require him to move his deposit accounts as well, which is a condition your bank imposes on commercial debt consolidation loans above $50,000. He declines the condition. You decline the loan. Both decisions are rational. Neither produces an outcome that serves the customer's actual interest. You understand by this point in your career that the credit system is not designed to identify creditworthy borrowers. It is designed to identify creditworthy borrowers who are also low risk to the institution, which is a meaningfully different criterion. The gap between those two populations is where a significant portion of the working economy operates without access to institutional capital. You understand this. You continue to work within the system. You are not certain there is an alternative that pays $127,000 a year. The bank's entire business model is the gap between 3.9% and 6.8%. You have been funding one side of that gap your whole life. Now you are the person who decides who gets access to the other side. 6 years after the branch. You are 31 years old. Your title is Vice President of Corporate and Investment Banking. Your base salary is $214,000. Your bonus last year was $163,000. You do not have a branch. You have a portfolio of 37 corporate clients with combined annual revenues exceeding $4.2 billion. Your job is to ensure that when those companies need capital, they need it from your institution. The product has changed. At the teller window, the product was a transaction. At the branch, the product was a relationship that generated transactions. At the loan desk, the product was credit access to capital priced at a spread. At this level, the product is advice. You advise companies on how to raise money, how to deploy it, how to structure their debt, when to acquire other companies and at what price, and when to sell divisions that are no longer core to their strategy. You are paid for the advice. The advice also generates fees. The fees are the actual product. The advice is the mechanism that justifies the fees. Last quarter, you advised on a leveraged buyout. A private equity firm acquired a regional logistics company with 1,240 employees across 7 distribution centers. The acquisition price was $314 million. The financing structure placed $206 million of debt on the acquired company's balance sheet debt the company did not have before the transaction. Debt that the company's existing revenue must now service at an interest rate of 7.3%. Your institution arranged the debt financing. The arrangement fee was 1.25% of the debt facility, $2,575,000, paid at closing. You know from the financial model that the debt service requirement will absorb approximately 38% of the company's projected operating cash flow. You know that 38% leaves limited margin for revenue softness. You know that the private equity firm's investment thesis assumes cost reduction of approximately 14% over 3 years. You know that 14% cost reduction in a logistics company with 1,240 employees has a specific meaning. The model does not use that word. The model uses the phrase operational efficiency optimization. The transaction closes on a Thursday. Your institution's fee clears on Friday. The announcement appears in trade publications that afternoon. The CEO of the acquired company releases a statement describing the acquisition as an exciting new chapter. You read the statement. You close the browser. You are not the person who will make the decisions that follow from the model. You are the person who built the structure that made the decisions possible. This is a distinction that matters in a legal sense. It matters less in other senses that you do not examine with great frequency, because examining them with great frequency is not compatible with doing the job at the level the job requires. Your compensation this year will be $377,000. You live in an apartment that costs $6,400 a month. You have $840,000 in investment accounts. You have a personal financial advisor who manages your portfolio for a fee of 0.75% of assets under management, $6,300 annually, billed quarterly. You pay it without examining it closely, because examining fees closely is a habit that belongs to people with less than you have, and you have learned, without quite deciding to learn it, to categorize yourself as someone who does not need to watch the small numbers. You are not unhappy. You are not happy. Those categories dissolved somewhere around year 4. What remains is orientation. You know where the next meeting is. You know what the next deal requires. You know which relationships need attention and which can run on maintenance. The machine runs and you run it, and the running is what your days are made of. At this level, you are not lending money or moving money. You are designing the architecture that determines where money goes and what it costs to get there. The architecture does not remember the teller window. The teller window funded the architecture. That is the connection. That is the whole connection. 14 years after the branch. Your title is Managing Director, Head of Corporate Banking, North America. Your total compensation last year was $1,140,000. You sit on 3 internal committees and 1 external advisory board. You have 47 people in your direct reporting structure. You have not processed a transaction since 2017. You have not spoken to a retail customer since 2015. You have not thought about the gap between $17.40 an hour and $340,000 in a single day since you are not certain when. The number is still true. You no longer have a category for it. The view from this level is not what you expected. You expected clarity. The higher you go inside an institution, the more of the system you can see, and seeing more of the system is supposed to produce understanding. What it produces, in practice, is a more detailed map of a territory that is larger than any individual can influence. You understand, with considerable precision, how the bank generates revenue. You understand the capital requirements, the regulatory constraints, the competitive pressures, the shareholder expectations, the analyst coverage, and the quarterly earnings cycle that organizes everyone's behavior whether or not they are aware of being organized by it. You understand all of it. Understanding it does not give you the ability to change it in any direction that the institution has not already decided to move. There are things the institution has decided not to do. It has decided not to serve customers below a certain asset threshold with its premium banking products because the margin on those customers does not justify the service cost. It has decided to price its consumer credit products at rates that its own economists know are above the threshold at which debt becomes self-reinforcing for households below a certain income level. It has decided that its charitable giving program, which amounts to $47 million annually, will be directed primarily toward causes that generate positive press coverage in markets where the bank is seeking to grow its deposit base. These are not secret decisions. They are disclosed in various forms in the annual report. They are not experienced by the people affected by them as decisions. They are experienced as the way things are. You made 3 of those decisions. You ratified 12 others. You are not certain which category is more consequential. You think about the teller window occasionally, not with nostalgia, with something closer to recognition. The teller window was the part of the bank that customers trusted because they could see it. The floors above it were the part of the bank that generated the returns that funded the floors above those. The loop is closed and has always been closed and will remain closed after you leave this role, which you will do in approximately 4 years when your equity vesting completes and you have the liquidity to make the question of staying optional rather than structural. You do not know what you will do after. You know that you will have $8.4 million in liquid assets and the specific kind of freedom that comes from having enough money, that money is no longer the organizing principle of your decisions. You know that this is what the teller at the branch you started in will not have when she retires. And you know that the distance between her outcome and yours was produced not by a difference in intelligence or effort, but by a difference in access to information, to networks, to the rooms where the decisions were made, access that you acquired, by accident, of timing and geography, and a single conversation with a branch manager who saw something in you and said so. You are not certain what to do with that knowledge. You file it with the other things that are true and that do not have an obvious action attached to them. The next meeting starts in 11 minutes. You pick up the briefing document. You read the first page. The machine takes another step forward. Somewhere tonight, a branch is closing. A teller is counting her drawer. The count has to balance, because if it does not balance, the discrepancy is hers to explain. She has been on her feet since 8:30. She processed $297,000 in transactions today. Her take-home pay for the shift is $108.14. She is 22 years old. She has not thought about the gap yet. She will. Above her, on floors she has not visited, systems are processing the data her transactions generated. Algorithms are running credit assessments on customers who applied online this afternoon. A leveraged finance team is modeling a transaction that will close next Thursday and generate $2,400,000 in fees. A managing director is reading a briefing document in preparation for a meeting that starts in 11 minutes. None of these things are secret. They are all disclosed in the annual report. The annual report is 187 pages long and written in a register that is technically accessible and functionally opaque. The teller has not read it. Almost no one who interacts with the bank has read it. The bank does not require them to. She initials the reconciliation sheet. She clocks out. She thinks about the $297,000. She thinks about the $108.14. She thinks about what lives in the distance between those two numbers. Most people stop thinking there. They file the gap in a category of things that are true and too large to act on and go home. Some people decide to find out what is in it. The machine needed her to count the money so it could move the money. The difference between those two verbs is the difference between every level in this building. The distance between them is not a flaw in the system. It is the system. And the system does not explain itself to the people who fund it. It only runs.